Welcome to the LSCRE podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrother, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more. Yeah, well, first off, we want to thank everyone for coming and joining us live here. Just for the record, there will be a recording of this podcast available for you following the episode. First things first, though, Happy New Year to everyone. This is probably the last day you can say it. There is a cutoff. According to Larry David, it was technically the third. If you're a Curb Your Enthusiasm fan, but nonetheless, Happy New Year to everyone. And we're very excited for our first live podcast of 2026. Going over arguably one of the most important topics to cover, I would say. I think when it comes to these live themed podcasts, these monthly live themes, we always have a very good and original topic that's very thorough and well researched and thought out. And a lot of times it's kind of talking our own book, but really implementing what we're seeing in the marketplace and how we're looking to execute. And I think today is no exception of that. So Rob, do you have actually any other things you want to highlight? I have a couple of things I want to go through, but do you have a couple of things you want to shout out?
I mean, we've got a ton to get through, so buckle up, everyone. This is going to be a super fun and informative live webinar. Feel free to be active in the chat. Let us know where you're dialing in from. Put any questions you want answered. We might answer them midway through, might answer it at the end. So just bear with us, but it's going to be a lot of fun. So yeah, I'm looking forward to getting started.
I got a little housekeeping here. Rob and myself and Sam Morris will be at the Best Ever Conference coming up. So that's number one.
So what does that mean? Are you inviting people to join and hang out with us?
So what I mean by that, the call to action there is we'll be there meeting in full force, hosting dinners, shaking hands, kissing babies, and Rob might be signing autographs. You never know. But with that said, we will be there in full force. Super excited for that event. It's kind of a big one, particularly Raise Fest this year for kind of our space of syndicating and stuff like that. We believe a lot of our partners are going to be there. We may be working internally on a exclusive fund manager invite only event, perhaps in the state of Arizona, perhaps not. So more on that to come. We also, by the way, will be hosting and we'll be doing our New York City flagship summit. So I'm going to go out early and say that one. So mark the calendars in October for that. And then we also have a deal coming up. So on
we
Monday.
Might save that for the end.
Oh, okay. Well, here, that's called a, and showbiz, Rob, that's called a teaser.
Yeah, we might just tease that for the end. I think that we'll save that for the end.
But let's just say the things that we're talking about in this presentation certainly are ideas and principles and core values that will be implemented in the video here coming up.
Someone, real quick before we move on, someone asks when is Best Ever? Also, we provide a copy of the webinar. I believe your underwriting tool is the best I've seen. Oh, thank you very much. So, and that's actually a great point. So a couple of points here. So first of all, when is Best Ever? Best Ever is February 17 to the 20th. We'll be in Salt Lake City during that time. So if you are planning to attend the event or be in the area, we'd love to meet with you, hang out. And then also, this is being recorded. You should be able to, you'll get an email with the recording after. It'll also be available on YouTube as well, as is all of our recorded content. And then finally, Luis says that our underwriting tool is the best that he's seen. So again, thank you very much for that. And for those of you who are wondering what that is, it's an underwriting tool. So it's just very simply a spreadsheet that we've built over many years and over thousands of deals being analyzed with it. Analyzing deals is not rocket science. It's really all about, it is so much more art than science as we've gotten more experience. And we'll be talking about some of that art today. But if you are interested in getting your hands on the model, you can go to our website, LSCRE.com, and you can download the model for free. So there's no gatekeeping. Like I said, there's no secret sauce here. Anyone can do this, I firmly believe. So if you want to go and download that, head to our website and you can get your hands on some of those great resources. So again, that is LSCRE.com.
I'll put it in the chat, by the way, too. And for those who are wondering, I put the Best Ever Conference link in there. I'm also going to be putting in our link here to our website. If you don't already know it, you should know it. It's the acronym, LSCRE.com. Easy enough. Also, while I'm at it, should I also just preemptively put in our LSCDD to do more market research on us and things of that
No,
nature?
no, no, no. That's
Okay,
giving away too much. One step at a time here. But you
I
can
see.
I'll drop the website just to make sure everyone doesn't feel left out. All right, but without further ado, I want to dive in because this is going to get long, this is going to get meaty, and I want this to be at the end of the day digestible for everyone attending as well as who will be listening to this after the fact. So, without further ado, I just want to talk about how to underwrite or how humbly we are underwriting multifamily deals in 2026. And we've been actually employing a lot of these strategies and I guess embodying a lot of these principles even before 2026. So in 2025 and even in 2024. And start off with saying a couple things. First of all, mistakes usually don't show up in your underwriting until year 3 and 5. So in year 1, those mistakes usually don't show up. They usually rear their head when there's a refi in year 3 or a sale in year 5, or you were hoping for one of those things to happen. And then because the underwriting was done improperly or not conservatively, that's when those mistakes come up where you were hoping to sell for a certain price in year 5, but then you have a, a, a rude awakening. You have to face reality. So I think we will talk about kind of what those mistakes are before we dive in as well into kind of some of the big themes. I know Craig, before we were recording, we were just talking about some of these issues, and so it's kind of a delicate topic, but it's something that we have to talk about. Mistakes, issues, pitfalls. So we will definitely be covering that in addition to our 2026 acquisition strategy, how we're underwriting, of course, the mistakes that we see others making. And then finally, when we're done with all those themes, we will pull up the underwriting from our most recent acquisition, which we just closed right at the end of December, and kind of share how all these principles look in action in a live underwriting of a real deal that we just closed. So yeah, with all that being said, Craig, do you want to kind of talk about the mistakes that we wanted to touch on kind of as a first big topic, just to kind of, these are like big, I mean, they might not be obvious on the surface, but once you drill down, it
Well,
becomes very obvious.
yeah, the issue, I think, I mean, it's a pro and a con. The beautiful thing about this world is that, and especially underwriting, although it is a mathematic, calculation and it is, essentially an algorithm, right? There is art to it. And unfortunately, sometimes that art kind of creates the fact that not all two groups do things similarly, right? A lot of people probably do, there's similar bucketings as to how people do deals, how they underwrite and stuff, but there's a lot that can get you in trouble, such as, paying people cash flow based off dollars that they've raised, inappropriate things like that. Is that kind of what you're referring to, Rob? Things
Yeah,
of that
so
nature.
I mean the thing I'm really passionate about right now is the fact that mistakes don't usually show up in year 1. And
Yeah,
with that being said, you can make mistakes where you are proven wrong in year 1. They're just easier to fix or they're easier to
yeah.
avoid. But
Well,
we've
and to
seen
your
it
point,
and we've made those mistakes. I mean, just as an example, something that you should not be wrong about, but could be is, for example, your property tax assumptions for year 1. That is not as excusable as being wrong about your property tax assumptions in year 5, because the further out in the future, the less knowable. But you should talk to your property tax consultant and get an estimate for what you think your property taxes will be for your first year of ownership. And again, if you do that correctly, you shouldn't be wrong in year 1, but it could still present issues down the road.
yeah, that's really a Texas specific thing. Other states are a little bit different. Texas is a state that you kind of litigate that and you kind of fight it and you work down to make sure you've got the lowest number there possible. So that's kind of one item there. Other items are, when amortization, if it burns off. Well, let's say you don't have a full term interest only loan and then all of a sudden, it's amortizing and your cash flow goes away or goes down, right? So it's a lot of things like that. Maybe your expense ratio is off. Right when you get the deal closed, there's kind of that honeymoon period. Reserves are, typically if you're working with a good group, they have reserves there. They haven't burnt through any of that yet, right? So things are usually pretty hunky dory and nice right when you take over, but it's as the deal goes on, And especially when we've been in a time period right now where there's not a lot of rent growth today, or at least the last couple of years. Now, we do think that's going to change here coming up. All those things really start to matter a lot more. When the rent growth is humming and there's a low supply, any deal will probably work out just fine. But when things are not on easy mode, like what we've experienced the last couple of years, and what we're seeing people do today currently in underwriting is kind of what gets us concerned, and what we really want to educate you all on, and how we kind of differentiate ourselves and how we've avoided this even from our own trial and error, from mistakes that we've made earlier on as a sponsor.
So another way to think about this concept of, mistakes usually don't show up in year one, but they will later, is the difference between underwriting cash flow and underwriting IRR. So a lot of people kind of come to understand, oh wow, IRR is a lot more manipulable than cash flow because IRR takes into account the future sale of the property. So now you've got the gray area of, okay, when are you going to sell the property and for how much? And it's harder to kind of negotiate and justify or argue against those certain assumptions because nobody really knows what's going to happen in the future. And you can kind of make the case, yeah, well, the market could rebound and the rents could grow and your exit cap rate could be this. But all that is has nothing to do with cash flow, right? Cash flow is much more real, and that's harder, therefore, to manipulate. But the challenge is that a lot of people know that. So a lot of investors love cash flow for various reasons because they feel like, okay, it's a sign of a good deal, it's a sign of lower risk, it's healthy because the deal is cash flowing, it's performing well. And I know it's it's harder to manipulate by the sponsor, so I feel better about a deal with cash flow. Well, the thing is, sponsors know that, investors know that. And so some sponsors actually raise extra reserves to bolster distributions. And so that's a very different deal dynamic than the deal actually distributing true free cash flow on its own accord. So that's something that takes another level of digging into the model, digging into the underwriting, and understanding what is the deal that I'm being pitched here? Is this true cash flow or is this somehow manipulated? And so it's very point blank obvious if you just look at the numbers and you can see how reserves are being used to actually uplift cash flow. But something that is very similar, but less understood and less scrutinized are what we call deep in the money interest rate caps. So this has been very popular to do when people are using floating rate loans. Instead of floating at a higher interest rate, they will actually purchase an interest rate cap that is less than what the prevailing rate is today. And so that's why we call it an in the money cap, because the second you purchase the interest rate cap, it's paying you out interest as a hedge. So typically, you have a floating rate loan and you'll purchase a cap which establishes a ceiling of risk on the floating rate. And it actually isn't paying out any value because it's out of the money, because here's the rate and then here is the ceiling. But when you buy an in the money cap, the rate is floating like this, but the ceiling is actually your floor and you're actually getting paid every month interest out because it has value. So, but the thing is these hedges are expensive. They're not free.
Yeah,
On
debt turns out to be very expensive any way you slice it. If you want to leave
right,
it
there's no way.
early, yeah,
Yeah.
any way you slice it, when the biggest partner is typically the lender, it generally tends to be expensive.
Yeah, and so it's essentially just prepaying interest. And so that increases your basis and it artificially increases cash flow because if you have deal A and deal B, and deal A has true free cash flow, net of all expenses, and then deal B has an interest rate cap, which is artificially bringing down the interest rate, and then the cash flow is the same as deal A, I still take deal A because deal B only has that cash flow because it has the interest rate cap. And interest rate caps, again, cost money and they run out of time. Interest rate caps are usually 1 year, 2 years, 3 years. And then when it's up, what are you going to do? You're either going to have to buy another cap, which is going to be a big chunk of cash, or you're going to not buy a cap and now you're going to revert to the market interest rate. And so you're either betting on interest rates coming way down, which maybe will happen, or you're just going to suffer having your cash flow be kind of evaporated and going back to reality. So so that's why you can't look at cash flow only or IRR only. You have to drill down and look into the specifics and understand what's going on under the hood because you don't want to get caught in this classic trap of bad deal, but the sponsor pre-buys in the money rate caps, pre-raises distributions, and makes the cash flow look better than it is. And then typically, or mathematically, if you're going to do all these things which are going to weigh down the basis of the investment, because basically when you buy interest rate caps, when you put all this money up front as reserves just to pay it out later, it weighs down what the total investment is coming in. And that means that there's a bigger profit that has to be generated on the back end to actually service all the upfront equity. See, the thing is, if you're buying a $20 million deal and you have to put up $10 million of equity just to buy the $20 million deal because you've got all these extra expenses, all these extra fees, all these reserves, all these interest rate caps, that $20 million deal is going to have to appreciate a lot more so that the 10 million can make its return. Whereas if you use the same amount of debt, but because you're not doing interest rate caps and you're not doing heavy reserves and you're not doing all these other things, maybe the $20 million deal could be bought with, to make a dramatic example, $5 million of debt. Now, that's $5 million less of profit upon sale that you'll need to have in order to generate the same return. That is huge. And so that's super important because it's harder than it looks to sell, real estate at a profit. And so what you need to be wary of is the game of making the cash flow in the short term or in the near term look better than it is through everything we discussed, and then making the exit look better than it is in the long term through the manipulation of future income and exit cap rates. So, sounds simple, but definitely something where you have to look under the hood a little bit more on.
Yeah, and everyone's model is a little different. Everyone's underwriting is a little bit different, as I mentioned. So sometimes it's hard to decipher, if you're looking at a good model, because marketing, advertisement, and brochures, all that stuff, they put it together, and a lot of sponsors do because it works. It gets, dollars and deals. But to Rob's points there, you got to be very wary about how, the sausage is made and what tricks can be played that you, the investor, may not realize is getting done.
Yeah, and we're getting some great questions in the Q&A. Craig and I will maybe try to answer some of them via text, and then we'll also answer live for sure as we get through it. But I want to dive into some of the broad themes now that are more specific to 2026 and in this current era that we're in. So first off, I want to talk about location. So location has been repriced. It's not 2021 anymore. Bad locations price at heavy discounts to quality locations. So there's the thing that happened was as the market appreciated, everything coalesced to one valuation, right? So it didn't matter if it was an amazing location or if it was a crappy location, everything was expensive. But now that the market has unwound that dynamic, there's actually this nice healthy curve where the Class C property in the poor area is a higher cap rate, perhaps even substantially higher than a really well located Class A property.
Yeah, and just to make this more clear for everyone who's listening here, basically what Rob was saying is that during 2021 and 2022, when the market was white hot, a deal that would be, in a less than desirable area with higher crime, things of that nature with not the greatest rents, the cap rate on that wouldn't be too dissimilar to newer product, 2000s and newer, in a great school district, in an area where there's a supply moat, right? The cap rates were tighter there than they should have done. Well, now that the market has normalized a bit, what Rob is alluding to is that better properties are finally being priced as such that are better. And these junkier deals, ones that are not easy to manage, the ones that have probably a lot of deferred maintenance, a lot of properties that are probably struggling with concessions and getting tenants in, are now priced at a higher cap rate. So there's now finally a larger dispersion between the two, which has created a lot of the issues right now, which is why, really, if you look at the marketplace, a lot of that B and C stuff is not able to transact because it's so below paper right now. We're still trying to find the bottom there, but as opposed to the higher end part of the market, 2000s and newer, and good locations and pockets, good locations in Houston, in Dallas, even some pockets in Phoenix, you name it, still has a market. But those deals are, quite competitive right now. But that C stuff, that 80s and older product does not have much of a market. So we're starting to see a normalization of those cap rates starting to widen, and therefore to be a true curve, as Rob was alluding to there on pricing.
So the big thing about this is, so it's actually so funny because in the peak of the market, 2021, the height and the hype, you almost did better the less analysis you did and the less scrutinizing you were. The worse quality property you bought, it would appreciate more and you would actually make more. So the more risk you took, the stupider you were, the more you made, right? And that's very hard for people to understand and to accept because we all want to be very smart. But thankfully, now is the time where it actually pays to be very smart and to be very diligent and careful. So we're putting an even bigger premium on the quality of a location, the stability. You really, in this transitionary period right now, you really need to look at the crime statistics and information at the property specifically, understanding was there, what kind of crime in the news that has happened at the property? What about crime that didn't happen, that didn't come up into the news? And then what about crime in the general area? What about the schools? And then last but not least, what about liquidity at exit? It's such a big thing always. And so people kind of forgot about it in the height of the market because there was unlimited money and everything was for sale and everyone was buying everything. But now we're back into a normal world where you have to really consider who is going to be your buyer when you go and sell the property 3, 5, 10 years down the road. So just because you can get into the deal doesn't mean you can get out of the deal. And it's very important. You just because you think to yourself, well, I'm not planning on selling this property anytime soon, doesn't mean you shouldn't be evaluating who the buyer is. You should really actually be able to picture the buyer or even name the buyer. Like, yeah, we're thinking about, these three types of groups because we know they own in the area and they like to buy this kind of product. That's going to give you the confidence that there's going to be real liquidity in that for that property in time. So last piece about this is if you are justifying the purchase today of a property just because it has a discount to peak pricing valuations, that's a red flag. That can't be the only reason why you like the deal because just because something is now worth less than what it was worth in 2021 doesn't make it a good deal because almost everything is worth less than what it was worth in 2021.
Yeah, also, I think the whole buying it at a discount, buying it at loan amount, well, the property still could be wildly underwater, and you're the sucker that bought it from the lender because, the lender needs to offload that and just get basically broken out at par and then have someone else manage it and not bring it down. So, buying something at the paper amount doesn't really show to me that great of a deal. It could just mean that you bought, worse product that had a larger peak to trough, meaning high to low, and you're there. Well, what about good assets that have been owned from a seller who was competent, who bought the deal in 2018 or 2016 to 2020, who has some equity on it, but it just has a maturity coming up? I like something like that a lot more because I do think that rent growth and just overall gains are right around the corner, and you don't need to take that large of a risk to still get outsized returns in a 2026 vintage asset. So let me say that one more time. You don't need to take massive amounts of risk to still get on a risk adjusted basis an incredible return. So that's why we're liking better located product that will be more seamless to manage in locations where there's not a ton of concessions, meaning giveaways to get tenants in there. Because if you have a lot of concessions, stuff like that, you're still gonna have to burn through those in order to find what true rent is.
Speaking of true rent, we're going to get on to the next subject, which is the importance of true rent. And so in this market, the game has gotten a little more complicated. So when evaluating a potential acquisition, comps is one of the most important things to evaluate. That's true for all real estate. But in this market, we're going beyond just typical comps and understanding what the rents are down the street. We need to understand all the fees from all the comps. So that goes for amenity fees, Wi-Fi fees, valet trash, tech fees. All these different fees have become very popular in the multifamily industry. It's not like it's not 10, 20 years ago when you'd walk into a property and there was just a base rent and you pay your electricity and you're good, right? The game has changed. And so you really have to look at what all-in rent is and that way you can compare true apples to apples because you can get in trouble if see for example there could be a deal down the street with higher rents and you go, oh great, we've got rent upside on this deal, but the thing that you missed is actually that the property you're looking at bills back for utilities or something, and then the property down the street has higher rents but doesn't bill back for utilities. Just a very simple example. That is going to change your math dramatically. And again, rents are super sensitive because revenue is a big number. Rents are a big number here. Then you've got expenses, then you've got debt, and then you've got cash flow. So this is revenue. Again, once again, revenue is this, then expenses, then your debt, and then what's left over is this much. So any change, tiny change from this is going to have a big change to your net cash flow, right? So that's why we agonize and spend so much time, and we want to lean on the side of conservatism on our rents rather than saying, well, we think we can probably raise them and probably can do this and do that. So that's a big thing that you need to look at. And so I want to share some of the details of how we actually do that. So our director of acquisitions, Brad, works closely with, we have a virtual assistant in the Philippines who works full time, and he spends a ton of his time just calling the nearby properties to our subject. So if we're looking at acquiring property X, he'll call all the properties near property X, and he's got a script that he's gotten super good at. When he calls the property, he will basically ask it all these different questions to get the full fee schedule, because typically properties don't share that, right? They will just, oh, the rent is this, and that's kind of they're trying to sell you, not give you all the information. And so he's kind of got a script to say, yeah, I'm thinking about a two bedroom, and then he'll kind of switch later and say, actually, I'm thinking about a one bedroom, and so he'll get the pricing for both unit types, and then he'll ask about, okay, so if I move in, what fees do I have to pay upon move in? What are my monthly fees? And that way we can get this full picture and understand what is the real true rents in the area, and we can hopefully comp to that.
By the way, I just had a question. How many deals do you buy off market versus on market? So this is just another kind of theme and core concept Rob and I talk about all the time, which is on market deals and how we do them. Basically, every single deal, only one deal in my tenure at LSCRE has been off market. Everything we typically buy is on market. Why is that? Because people have a fiduciary responsibility to their investors to test the market. There's not a lot of off-market deals in this $30+ million space that we play in, what's known as the middle market space. When you're acquiring deals $35 million to $70 million a piece, there's not just this off-market secret shopping, this, that. If there's every deal that's off-market like that, usually it's a terrible deal or they're pre-marketing it and you might be the sucker that pays for it. So there are very rarely good instances of finding an off-market in this space, particularly in the locations we're looking in.
Well, I mean, to say it more broadly, I would say there's very few actually good deals, period, not just off market or on market, right? So it doesn't really matter too much whether it's on market or off market. The likelihood of it being a good deal is low, any way you slice it. So that doesn't mean we have really a bias towards either, right? We pursue all opportunities. And actually, the deal we most recently closed was off market. The other deal we closed in October was on market. So opportunities come from everywhere, but just because it's one or the other doesn't make it a better opportunity or not.
And then in the same vein, someone just asked, are you overpaying when bidding against the syndicators? Well, number one, whoever's buying a place automatically is paying the most. And just the other thing, why would some group just give us a favor of giving us some dislocated pricing? Like the other group's incentivized to make money. They're not just going to give it away to you for a song, the property, right? So that's a bit of a fallacy.
Yeah, I mean, I don't want to get distracted because this is a whole other topic, but just to add a little more color, as you can see, Craig is passionate about this topic. Basically, what Craig is saying is in the space that we're playing at, which are 40, 50, 60 million dollar deals, the sellers have a fiduciary responsibility to their investors. And these are sophisticated investors, these are sophisticated sponsors and owners.
Sometimes institutions that are very reputable that have got,
Institutions, they have
yeah,
investment committees, they have boards.
pension funds, Life Co. Yeah.
So baked into their operating agreements, it'll say you have to list the property for sale with an approved national brokerage firm, right? So it's the CBRE, JLL, Berkadia, it's going to be a big name, it's going to be a big shop. So they're not going to make a mistake on who they list with when they go to market. And they're certainly not going to sell off market because it's right there in their legal documents that they have to go and list the property for sale with a national reputable brokerage firm. So it's extremely rare to find a deal opportunity in this kind of 30 million plus, I mean even in the 10 million plus range that's true off
No
market.
one's giving away these properties. I think there's just some like myth because so many, groups out there, frankly, tout, oh, we got this deal, this, that. It's like, guys, it's a marketing pitch. Very rarely does it actually make sense. We bought our off-market deal because there was a reason behind it. The seller was looking to do a 1031 exchange and they needed an extended period of time. That's a unique circumstance. And they also weren't losing money on this deal. They bought this deal in 2017, I believe, either 2017 or 2018. So they had equity packed in from buying pre-COVID there. So that's why they had to sell the deal and they chose to work with us because they needed a slightly flexible closing window.
And also, we don't really know the true answer either. I mean,
Yeah,
honestly, I don't, I
that's
don't
what we were
know.
told.
I don't
Yeah.
know why they decided to be so private and they said, "Hey, we want to only go to one group that you trust." It was still through a broker, but the broker was told by the seller, "Just take it to the one group that you think will do the best for us." So they took it to us and we made the deal happen. That doesn't mean that we didn't overpay. We could have still overpaid, right? It just means there was less price discovery. So there was actually less, I would say, market validation of our price because it was just we threw out a number and that number was accepted and that's how the deal got done. It was not like when you go through a bidding process, you kind of get market validation. And so actually there's some positives, some reassurance on the reassurance, I should say, on the deal that we bought in October, just as an example, because we were bidding against big groups with great names. And so that made us scared and nervous about winning the deal because we had stiff competition, but at the same time made us feel very good because we thought, wow, if these groups that are big, smart, they don't mess around, they don't buy deals that are headaches, if they are competing on this deal too, they want this deal, that means we're on the right track. This deal is in fact something special. So we got to move on from this
Yeah,
topic.
let's save Rob all questions for the end now at this point so we can get through the meat and potatoes of it and then we can do a longer Q&A perhaps at the end.
Yeah, and we might even have to do a part two here as well.
It's juicy, I know. So sorry we digress. Back on track.
No, just you digress. I'm
Hey,
perfect.
keep the questions coming as they come in. We will answer them or try to get to them, but please just keep the questions coming in there. We'll answer them later. Rob, take it away, please.
Okay. So the last thing we were talking about was the importance of true rents and understanding what the whole fee schedule is and all that stuff. Very similar topic is concessions. So concessions is a super hot topic because we're seeing them everywhere. Over the last couple of years, we've seen record multifamily development. So you've got all these new projects delivering to the market. And when a project delivers, it starts at 0% occupancy. So what does it do? It's a race to get to 90%. And a new property will do anything to go from 0 to 90. They will offer tons of concessions that could look like months free of rent. It could look like $1,000 gift cards, anything. And so you really need to evaluate. And the thing that happens is as soon as the new developments that deliver start offering these concessions, those concessions are not contained to that property or even to that type of property. It trickles down throughout the whole market. So then all of a sudden now the non-brand new A-class properties feel the pressure because their residents are jumping ship. So then they start offering concessions. And now the B-class properties are feeling pressure because their residents are jumping up to the A-class property because they're going, wait, I can upgrade to this property. It's safer, nicer gym, more amenities, newer finishes at cheaper rent because I get 2 months free. Okay, well, they're bouncing. So now the B-class property is losing people. And then it continues on down the chain, down to C-class. So C-class properties are not immune to this oversupply dynamic. And that's why we're seeing concessions across the entire spectrum. So even a 1970s vintage asset is offering concessions in many markets today. And so when you are doing your comp analysis and you're looking at a property, one of the biggest mistakes I'm honestly seeing is when people look at these types of deals, number one, they might miss the concessions. And so when they're analyzing the subject property or comps, they might miss the full picture as far as what concessions are being offered and how that's actually truly impacting the financials. But then the other mistake they're making is they're assuming that the concessions get burnt off faster than a realistic pace. They're just saying, oh yeah, well the deal has concessions right now, but as soon as we close, those concessions are going to disappear, right?
Well, the broker said
The
that
broker
the
told me
rents were
so.
strong. Yeah.
Yeah, the broker told me so.
And the sponsor assured it.
Right. So the broker told the sponsor told the investor put in the money, and that's who loses. So anyway, So that's concessions. You really need to evaluate it. Like, for example, we were looking at this deal earlier last year. Everything was penciling. Love the property. It's really nice, good location, new asset. I was getting excited. But there was one thing that wasn't adding up. The property was not offering concessions. And that's great. We think, oh wow, it has that much demand, it's that good of a deal. But every single property around this property was offering concessions. So something was up. Something was just not adding up, and we just were not comfortable with the situation. We figured, we don't have proof, but we figured the seller was hiding the concession somehow. And that's not uncommon. So we didn't get to the bottom of it because sometimes it's easy to find. Like you just see that they're booking the concessions as marketing expenses, right? So they're buying $1,000 gift cards, calling that a marketing expense, and then giving it to the resident to move in, and it's not a concession. So that is an example of being careful and wary about these concessions.
Yeah, the general location around, just to put a bow on that thought and topic, is the general location around your property, for the most part, will have a correlation as to what you're gonna have to do to get rented. So be very careful with regard to that. And if someone doesn't pass a smell test, there's plenty of other good deals or good places to put your money. There's other good opportunities to buy. Be patient. Investing, there's no striking out looking really in investing.
Okay, so the next topic is distress. Everyone's like third or fourth favorite word, right? First favorite word is value add. Second favorite word is off market, and now here we come is distress, right? If you want to if you want to convince an investor that the deal is a good deal, you go to an investor and you say, "Hey, I've got a value add multifamily opportunity that's off market and it's distressed." And everyone thinks, "Oh, wow, this is amazing." Now, so let's talk about the realities of what distress is. So there's two types of distress. First of all, there's financial distress and there's physical distress. So financial distress is basically the property does not have essentially the cash flow to meet its debt service or pay its expenses. So there's a financial distress. Physical distress is the distress that you can see with your eyes. It's low occupancy, it's crime, it's deterioration of the condition of the exterior and the interior of the property. So that is the two types of distress. And the thing about that is, yes, it is exciting to buy a distressed deal because you could hopefully turn it around, assuming that you can buy it at a price that is cheap enough to go through the brain damage, the time, the risk, and the cost of the turnaround, and assuming that by the time you turn the deal around, it's worth a whole lot more than the time, money, brain damage that you put in, right? So that's why a distressed deal is attractive in the first place. It's a lot of assumptions. You hear one word and then people make all these assumptions, but it's not what we've seen so far. It's not usually the case. So there's, first of all, not a ton of distress. Second of all, because there's not a ton of it, it's not enough really to actually make the deal trade at a big enough discount to make it worth the headache. Because
Also, a lot of the distress is for deals that we talked about before, kind of that stock that's, maybe 80s and older, 70s older, in terrible locations on deals that are way below the paper amount, basically meaning that the debt was at X and now the property value itself for less than that debt and equity amount, right? So there's a lot of properties that just don't make sense that although there's distress there, you wouldn't want to buy them, own them, operate them, or even walk them.
it's very true. It's very, very true. So now let's talk about what's happening where there is real distress. So the next layer of analysis that you need when it comes to distress is you need to understand when you're looking at a potential distressed deal, you have to look at who are the owners around the distressed property. Because if you have a deal that's distressed and all the other properties in the pocket are also distressed or owned by bad operators who are distressed at an operator level, right? Because you could have a property level financial distress, property level physical distress, but you could also have an ownership level distress where maybe the whole portfolio for the owner is going bust, they've got a bunch of problems, and they can't really put the time and effort into making that property operate well. That is a recipe for disaster because if you are in a pocket like this, and we've seen a handful of deals in East Fort Worth, for example, where there's distressed deals, and there's just a bunch of bad operators that own all next to each other. And what happens is it's a vicious cycle where the crime gets worse. There's more bad tenants that continue to accumulate into these properties. And even if you buy one of those deals and you're an amazing turnaround specialist and you're going to put in the money and the effort and you're going to do the lease up, your deal will not be immune to the overall decline of the market. So different neighborhoods don't all just go up in value. Don't just like crime doesn't only go in one direction. Things can actually get worse for a submarket, and this is one of the reasons why. If the owners in that area just don't have the money to keep the neighborhood up. So you just can't forget that for a turnaround play, you can fix a property, but not a neighborhood. So I actually really
Yeah,
like this from
age-old saying, by the way, you want to buy the worst house on the best street, not the best house on the worst street, okay? Meaning you can't change the location, the three L's and three principles of real estate: location, location, location.
Yeah, so and then on the kind of like on a more positive note, when it comes to this sort of analysis of ownership around you, you can use it in the reverse. So something that we look at a lot is when we're buying a property that's in a good location and it's a stabilized property and it's a great deal that we're super excited about, we'll do the same exact analysis. We still want to look who are the owners near us. And yeah, you could think about it in terms of competition. You could say, oh, well, these owners are these are good owners and good operators that are nearby. Those are our competition. That's scary. On the one hand, that might be true, but at the end of the day, you would rather have big, smart, quality operators owning nearby you because they're going to help lift the entire area up with you. You got to win together. So that's number one from an operational perspective. And then the other thing is it's a big vote of confidence to see quality owners near the property. Like if you see quality owners and they're selling in that area and they're trying to get out, that could mean something, right? But if they're owning there and they've owned there for a long time, that's a great sign.
Oh, they want to refinance and then put new equity into it and keep managing it or whatever. Awesome, awesome plays.
Yes, exactly. Okay, a couple more points here. So first point is when it comes to value add, right, where we're actually doing renovations to the units and we're increasing rents, you have to have bulletproof justification for that in this market because what we talked about earlier with supply, that's causing concessions and it's also causing negative rent growth. And so it's very difficult to actually justify value add in a market like this because the rent increases that you're able to pull off in reality may not be what they seem. It could be much more challenging to actually get the true ROI because as we've seen construction costs go up, we've seen the amount that you can increase rents from a renovation play go down. So that's something that you need to look at. You need to look at what's the real cost versus the real increase that you can get. And you need to think about the absorption pace of those renovated units because anyone can we have a property that's in a horrible location and it's 1970s, like the ugliest deal in our portfolio. And uh, we had some roof damage and one of our buildings was just down. Like we had to renovate all the units in the building, 12 units. And when we brought those units back online, they were basically brand new units. They were nice. And so we were able to lease them out at a higher rent, at least $100 more. And this is a market where rents are $700. So we're talking super, super low end. So a $100 rent increase is a lot as a percentage. And even in that horrible property, horrible location, we were able to increase the rents in that circumstance. Was it worth the money to do it? No, not really. But even more importantly, could we do it across the entire property? And the answer is no. We could do it on those 12 units and we could find 12 tenants to go and rent from that rent there. But for the whole 250 units, no, we couldn't do that. So you have to consider absorption when you're talking about renovation. And so this is where it comes to this topic of don't trust failed value adds. And what I mean by that is a lot of properties hit the market for sale and it's a 200 unit property. And let's say they've renovated 20 units and those 20 units are getting a $100 or $200 rent increase or whatever the offering is claiming. So And then basically they're pitching it to you and saying, hey, we started it, now you go finish it, right? We did 10% or 20%
Proof
of
of
the
concept.
renovations. We've proven it out. Low risk to you because we've proven it, right? It's proof is in the pudding, and now you just go and make all the money. You go and finish out the renovations. You're going to raise
Like
all the
so
rents.
we're charitable.
Yes, basically the seller hates money, as we say. So be very careful about that right now because the reality is just because they pulled it off on 10, 20% of the units doesn't mean that you'll be able to pull it off on the entire property. And number two, you have to really analyze what the true rent increase is because what we've seen on a lot of these is when you analyze the rent roll, yes, maybe some of those units leased up at $100, $200 rent, whatever it is, but the average, the days on market are longer. The vacancy is all concentrated in the renovated units, and then all the classic units that are cheaper are full. So tenants are demanding the affordable option, and the vacancies in the renovated option, the actual rent premium is much lower than you think. We call that a failed value add. Don't, I'm not saying don't purchase a deal that is a failed value add, but don't buy the narrative of the failed value add and pay a premium price for what you think is an opportunity.
Two questions. Okay. Number one, if you're going to spend the going rate now to get to a premium, which is probably fairly to say 10,000 on the low end, maybe 15 on the high. So let's just call it 12.5K for a round number. Where do you need to trade that lease out? You know, how much of a rent bump do you need to get in order to justify that?
Okay, so we think about it in terms of a minimum acceptable ROI of 20%. That's $208 a month of rent
So,
increase.
what you just for everyone here listening, I really want you to conceptualize this, right? So close your eyes, think if that's how you do it, or write it out. If you're going to spend around 12.5K to do a unit, you need to basically turn that unit, basically not collect rent for a couple of weeks or a month, and then get a new tenant in there that's paying north of $208 on that. Let's call it $210 on a monthly ongoing basis to make it justifiable for that. Okay. The other thing that you need to consider is when you do a value add, you are resetting your basis on that property. Okay. So if you're going to do 100% value add, if your business is going there, let's say you can pay at a competitive price for an 80s or 90 vintage property, and then it ends up probably being more than 12.5K per unit. Next thing you know, you actually, if you have an 80s or 90s deal, you could be competing against 2000s or newer stock, even new products sometimes when you're making an investment like that. And let me tell you this right now, older product like that's like 70s, 80s, and 90s will never feel like 2010 or newer. Okay. So it's really scary and problematic to do it that way. So that's why ultimately, Rob, do you ever want to do value add? And this is gonna get, the comment section and the chat here fired up. But Rob, point blank, do you want to do value add and do you believe in value add? From
No,
a traditional sense of turning units over like that. Do
no,
you
no.
believe in value add?
No. I want to avoid value add as much as humanly possible. We'll only do it if we absolutely have to, if it's the absolute best way to make money, but usually it's not. Usually it's way better to avoid it, and it's better just to sell the dream to the next guy because there will one day come along a buyer with a value add story in mind, and they will overpay for the property, and you didn't even have to put any money into the deal, and they will pay you for the deal as if you did. So it's definitely not the best strategy, and it's for us personally, it's best to avoid at all costs. That doesn't mean we don't do renovations. It doesn't mean we have construction in house. We do a bunch of stuff, but it's ideally not.
Do you believe in ripping everything? Ideally not. Do you believe in ripping out perfectly good countertops and taking out perfectly good paint to show everyone the premium and the white paint that tenants care so much about? Do you believe
No,
that?
no, I really do not like that. I think only replace if it's broken, repair, repair, repair. This is a conversation for another day, because we could go in very big depth in about basically turnover costs, lease trade outs versus renewals. What's the value of a renewal? The most valuable thing in our business, point blank, period, is a renewal. So if you can get a resident to say yes to another year of rent, even if you don't raise the rent on them at all, that's worth like a $200 rent increase a month, basically. It's worth a ton. So Yeah, it's very hard to actually justify on a cash flow basis. If you're truly thinking about ownership as cash flow ownership and not as a flipper, if you're thinking about flipping a deal, you have to do construction, you have to renovate, you have to flip it, literally, right? But if you're thinking about true cash flow, true ownership, true money, like if you are investing, like all the rich people I know who own property with their own money, they don't willy-nilly just throw away perfectly good stuff and replace it just because they'll get a little rent increase, right? Because it looks good in the marketing brochure, we raised rents $200, but you're not going to break even on that cash expense for a long time.
Yeah, and here's the other thing too. This is all caveated. We will at some point be doing more of the traditional value add, and there probably will be properties that we'll acquire even this year that have got some component where we might budget some dollars at some point during a 5 to 7 year business cycle to improve units or return that capital back because we think that's most efficient. But today, when there's a ton of new stock online, and there's vacancy can be tough, concessions can be tough, this is the last time in the business cycle to do value add. Unfortunately, a lot of people are trained to only want to do value add deals because they got disproportionately rewarded during a really rare market blip, is when the market got super, super hot. So I caveat that to say that we don't believe that model today. At some point, we will be probably doing it, but doing that right now doesn't make sense because you and every other property is competing against the ton of new supply and single family homes completely dropping in their rental pricing as well. So when everyone's going up in quality, improving and over renovating your units is the worst thing you could do. You want to buy good real estate at a fair price in good growth markets with no concessions. If we boil it up, I would say that's how we would summarize our acquisition thesis today, with some sort of operational inefficiency and maturity coming up, forcing the seller to have to depart from the property.
Okay, so let's move on to cash flow coverage, DSCR, ICR, loaded ICR. So we actually had a question come in from an anonymous attendee. Thank you for the question. In 2026, are you going to move forward with LICR, which is loaded ICR, instead of DSCR when evaluating? If so, why? So I really appreciate this question because this means you're sophisticated. This means that you're keeping up with our, our updates and stuff. So basically, ICR is something, or specifically loaded ICR, is something that we have really developed and heavily focused on over the last year. And so basically, it is an all-encompassing cash flow or debt service coverage ratio metric that we really like, and it's what we focus on more than DSCR. So it is true, we do look at both, but really more so heavily focused on loaded ICR. And the big difference is because when you typically most people, they go to the lender and they say, hey, here's the property I want to buy. What's the maximum loan that you will give me? And then the lender will crunch all the numbers and then they will decide, yeah, this is what we feel comfortable giving you. And then that's what the borrower will take. So we kind of go the opposite direction. We look at the deal ourselves and we say, this is how much debt we feel comfortable. And then we go to the lender and tell them, here you go, here's your answers to the test. And so we do that through the ICR because we don't want the deal to be underwritten through the lenders, because lenders, they got their own way of looking at things, and we want to look at things as an owner. And so the big thing that's important here about ICR is we're looking at the true net income after CapEx, after all expenses, after asset management fees, all that good stuff, because that's real cost to the deal. So traditionally, you don't include those things in your net operating income calculation, but it still factors into cash flow, and that's still cash leaving out of the door every single month. So what we do is we factor in all expenses after everything. The accountant fees, the legal fees that we might have, the asset management fee, the CapEx that we spend, all that. And then we have net income, and then we compare what that number is versus debt service. And we want to see a 1.5x ratio. So, for example, we'd want to see net income after all expenses of 150K, and the debt service is 100,000. So that way there's true free cash flow that we could distribute out to investors of 50K at the end of the day. So that's
And,
what we
and
looked at.
yeah, and something that just differentiates us compared to other people is a lot of folks don't look at it as a renter. They look at it as, okay, well, how can I just get this deal closed? And how can I just survive? And how can I just get through? Oh, well, the lenders are going to require, only a certain amount of dollars for recurring CapEx. Although we think it might be more, hey, we'll just put that in, but it's, older product. Or, hey, well, the lender will give us this much debt. Okay, cool. Let's just take it, right? Well, we do not view the world like that by any means, on an ongoing basis. And we're looking to do deals with a lot lower leverage right now. And what we're also looking to do deals with full term interest only. When you do those things, you are ensuring cash flow, and your DSCR number is always going to be at a very, very comfortable point. We're looking to SWAN, which is sleep well at night.
Love it. Okay, and then the last point about loaded ICR and just debt service coverage in general is that the going in cover. So a lot of people will say, oh, the DSCR of the deal is X. The DSCR of the deal is Y. And the question is what are they talking about in terms of when? Is it trailing? Is it day one? Is it month one? Is it year one? Is it year two? Is it some other magical non-temporal period? And so you really want to focus on the going in coverage ratio from a debt perspective today more than ever, because when you're not seeing immediate rent growth, when you're not buying a deal where there's this easy value add where rents are skyrocketing like they were in 2021, you have to really rely and be comfortable with where your coverage is at going in. And that's a big difference between like traditional, more conservative long-term financing versus bridge, because bridge lenders will actually loan you money not based on a current income or current debt service coverage ratio. They'll lend to you on a pro forma or a future coverage ratio. And so that's not what we do. That's not what we're comfortable with. So we're looking at the going in coverage to be real, to be there. And that makes us feel very comfortable from a cash flow perspective. Okay, we only have a couple minutes here. So what I'm going to do is we're going to try to race through some Q&A. I might even share the screen. I totally forgot to give the intro that I wanted to give. So thanks everyone for being here. What I will say is we did not share the screen and go through line by line through the underwriting. And what that tells me is that this is a more sophisticated presentation, because when you talk about sophisticated underwriting, it's no longer in the spreadsheet, it's in here, right? It's the art of it, it's the nuance. And so anyone can learn to kind of just copy and paste and plug and chug and crunch numbers. This is not number crunching, right? This is understanding the nuance. So I hope you guys got a lot of value out of that. And we certainly will do the share screen another time if you guys want it. And that will be super cool too. So a couple questions here in the Q&A to try to get into. So Chris is saying, in the last few years, there's been a flight to quality. The same groups who would value at 1970s are now buying 90s and newer. Do you think this lack of demand for older assets today will create value in the future when 90s and newer becomes too expensive? Yes, I love that point, and I totally agree. We call that dumpster diving. There will come a day where dumpster diving is profitable, and that might be right now, actually. Just by the way, basically what that means is the 1970s deals that everyone's too afraid to buy, that no one wants to touch, they might get so cheap that the seller might be willing to sell for a number that you can't say no to and that you will guaranteed to make money from. The challenge will be to raise the money because no investor is going to want to back you on that. So you're absolutely right, but not as easy as it sounds. Okay, Mitchell, thanks for being here. He asks, earlier we made a good point about sellers kind of playing games with the financials. He says, I think if we all take the T12 and rent roll at face value, but sellers do and have lied. Any advice for ensuring what sellers brokers are telling you is legit? Yeah, asking more questions, seeing more of the financials, different documents like the AR report and different periods for the financials. But I think the biggest thing is just looking at the comps. You have to look at the comps
Yeah,
because
keep going. I have another point for you.
yeah, I mean, when we look at a deal, we don't care too much about what's happening at the deal specifically. We really care about what's happening in the comp set.
Yeah, so make sure Mitchell on that one, and I hope you're doing well, and hope to see you at BEC here coming up. I know you're a Utah guy, but number one, call all the local comps in the area and do your thorough due diligence there. Don't just take the, T12 at face value. And then also just another holistic thought, get to know your brokers, get to know your investors, get to know the people that you work with, your lenders, have enriching conversations. Don't treat everyone like a transaction because guess what? that individual that you have a further and deeper relationship, it's a lot harder for that person to lie to you if you've gone to dinner with them, if you've broken bread, if you know about their kids, if they know about your kids, Mitchell. Things like that are super important. This is a human business. I mean, Rob, we've probably got awarded how many deals the last couple of years because we've been on it and doing the little things correctly every single time we go to Dallas, Houston, and San Antonio, right? And be meeting with people. So those little things like that really do ensure that you get the best out of your investment, your asset, your acquisitions, and the information that you're getting on the front end.
Awesome. Okay, we've got time for a little bit more here. Chris has another great question. He says DSCR factors in principal. If you have a DSCR of 1.25, wouldn't your LICR almost always be 1.5x? I love the question. It's something I thought a lot about myself. And so I'll share my screen super fast and show you uh, an example. So here's the example. This is Whispering Winds, the deal we closed in December. Amazing property, super good location, old 1985 vintage, but really good location. So if you look, the traditional DSCR calculation would be the NOI of the property, and you could look at the trailing NOI if you prefer, but typically the lender will look at a pro forma, meaning adjusting the expenses. This is a unique deal. We got a 50% tax exemption, which is why you're going to see the numbers look very good, very attractive, because actually you can see we're cutting the property taxes in 50%, so it's huge. But so here's the NOI, and then this is the DSCR calculation here, and this is a PMT function. So this is principal and interest, and so this is just the interest dollar amount, but this is the DSCR calculated on a principal basis for both of these numbers, the trailing and the adjusted year one. You can see for year one, we're only projecting a 1% revenue increase. So it's not even like we're, manipulating the numbers or getting ahead of our skis here. This is very conservative. So with that being said, with the higher expense load, the OG expense load, it's a 1.43 DSCR. And then the year one is 1.68. And then if we look at ICR, it's 1.76. So it is higher than the DSCR in this case, but not by a lot. And so that's just a function of the below the line expenses. So here we have recurring CapEx of 286,000 per year, which is on the heavier side. So we're actually assuming to spend $1,000 per unit and more every single year in recurring CapEx. And so that's higher than a lot of our properties because it's an older property. So, and it's bigger units. So we're being conservative here. And, we've got asset management fee, construction management fee, professional fees, legal fees, accounting fees. And so all that is here as well. So we take this number of NOI, subtract these below the line expenses, and then we divide that by the actual debt service, which is this deal's full term IO. So it is based on an interest payment, which is the real cash. That's why I love the loaded ICR calc, because it's all real cash in, all real cash out, and then you look at the two. And so that gives me a 176. So I feel very comfortable, very happy here with this loaded ICR. So hopefully that makes sense and why 1.25x DSCR doesn't give you as clear of a picture when you're looking at doing full-term IO loans like we typically are, and also properly factoring in below the line expenses. Because I'll just tell you straight up, a lot of sponsors don't even have this. They assume all the expenses of running the deals right here. The reality is it's a lot more expensive to run these deals. Things break more often than you think, right? You don't actually fix up a deal once and leave it. It continues to break every year. Hopefully that answers that question. That's a super great question. We are out of time, so thanks everyone for the great questions, great presentation. Really enjoyed this. We would love to do this again. We will be doing it again. We'll be back next month, and we'll definitely revisit this topic because we see how much you guys.
Might have to do a part two, and maybe
Yes.
do we do a bonus episode perhaps so we don't have to do different programming. We've got a lot coming up. Actually, no, we're not done yet. We have a deal coming up. We have to tease it. Okay, we got make my life easier, Rob. Tell them about the deal.
Well, yes, I'm running late to my meeting, but no worries. So basically, we are putting a new deal under contract in Houston. I can't say too much about it yet because it's not under contract, but you will be learning a lot more about it soon. So we're super excited to share more. It's going to be a very, conservative core plus. I would maybe say like B plus, A minus type deal. And it's very stable with true cash flow day one. This is something so hard to find these days because everyone's either trying to sell you a deal that has like fugazi down the road cash flow, or it has, or it's just too nice of a property. So it's stabilized. There's really no upside. There's no cash flow ever. So this deal, it's really, like I said, it's rare to find where there's true cash flow day one. You don't have to manipulate the numbers. You can factor in all your expenses. After factoring in all expenses every month, like I just showed you in the spreadsheet, to still have cash flow to distribute to investors, that's very powerful. So that's I mean, all I can really say for now about the deal, but if you want to learn more, we can definitely talk offline.
Actually, no, with that said, email me, Craig at LSCRE. And if you're looking to invest with us or partner with us and bring equity to our offerings, we don't bring equity to other people's offerings. We don't do other people's deals, just so we're clear. But if you're looking to raise money for our deals, or if you're looking to invest in them, please book a time on that investor link. And or if you've got an inquiry regarding anything, I put my email in there, Craig at LSCRE.com. I've said it a billion times, but here's the billionth and first. Craig at LSCRE.com. And if you're looking to book a personal meeting to learn more about investing with us, partnering us, or anything of that nature, reach out to me. Would love a little context if you put the meeting in there just to make sure that we are a fit. Time's going to be incredibly scarce here coming up with the launch of the deal coming here shortly, amongst everything else, getting back to it. But I will always make myself available for new partners and investors.
Love it. And I'm making a note of all these questions right now in the Q&A, so don't think that your question is being forgotten. I'm downloading them into my brain right now. We
I
will be
actually
doing.
love that. Why don't we say, do you want to screenshot these questions, or are you
Oh,
screenshot copying
I'm
them?
using my brain to screenshot them. Don't worry.
Oh, well, I'm going to screenshot them right now then, just in case, because I want to make sure we get to it. And that'll be a teaser. Watch next week's episode or coming up. We will put a mailbag episode in going over all questions that are there to go over and have a continuation to this.